Dear investors, I'm Joshua Tan, strategist at Phillip Securities Research. Markets have two issues to contend with. Number one, the Eurozone crisis, and number two, the fact that globally growth seems to be slowing down and risks of recession are high. On the Eurozone crisis, we maintain that complete fiscal union, including shared revenues, joint liability, budget oversight, and a joint economic policy is ultimately the best way to address the fundamental cause of this problem, which is that a competitively diverse Europe under a single monetary policy will always be growth suboptimal. As debt levels are cripplingly high already and refinancing rates unfavorable, austerity is not a sufficient answer. The Eurozone has to grow out of its debt, and ultimately, a joint policy aimed at equalizing competitiveness implemented through a fiscal union is the most effective. Right now, Merkel and Sarkozy use the phrase fiscal union, but what seems to be on the table this weekend is only collective budget oversight, something legally enforceable by penalties should a member nation violate a budget. This is a mere baby step towards fiscal union and does not address the competitiveness issues. As it seems likely that fiscal union will take a very long time to achieve, and that much needed growth is likely to be not forthcoming, we need circuit-breaking measures to prevent markets from abandoning the Eurozone in the interim. As we have said in our reports, we do not have a good circuit breaker in the EFSF. At the same time, the European Central Bank has made it clear that in this respect, it will only work within its mandate of supplying ample liquidity to the banking sector and also to the governments in the form of limited intervention in the bond markets to keep interest rates low at an affordable level. But it will not conduct deficit financing or unlimited debt monetization. It went further as to say that there should be no presumption that they would do this, even in the event of further fiscal integration. As addressing the fundamental flaws of the euro will take time, the negative sentiment, we think, will further dampen an already recession-looking Europe, and in turn affect Asia, which is also rapidly slowing down. The only country posting positive economic data is the US, but we have reason to believe the US is an anomaly. We think certain tax incentives to purchase capital investment are expiring end of the year and could be having the effect of bringing forward purchases. Gains in manufacturing are therefore at risk of slowing down in January. Furthermore, other fiscal supports aimed at supporting consumption are coming up for renewal, and there is a chance they may not be renewed. Given the risks, our view on the STI remains bearish over the larger trend. We may turn more positive if, number one, Europe gets on the road to fiscal union, and number two, if economic indicators in Europe and Asia stop corroborating contraction, and the US actually continues to hold up. Thank you for watching, and tune in again for another weekly PhillipCapital Market Watch. Thank you.